Before we get started, just a quick heads up, this briefing is for educational and informational purposes only. It is not financial advice. You should always do your own research and consult with a professional before making any investment decisions. All right, welcome. Today we're digging into Lindsay Corporation's second quarter results for 2026. And what we're seeing is a company that's really at a crossroads. Its two main business segments are feeling completely different market forces, pulling them in opposite directions. So let's break down what that really means for the business and, of course, for its investors. So here's our game plan. We'll start with the big picture, the overall Q2 performance. Then we're going to do a deep dive into both the irrigation and infrastructure segments. After that, we'll shift gears to look at their capital strategy, super important, and we'll wrap up with what management is saying about the future.
Okay, first up, the big picture. Now, on the surface, the numbers look pretty challenging. But as you're about to see, they tell a much more complex story about two very different business environments colliding.
The first number that jumps out is the top line, a 16% drop in total revenue compared to last year. Now, a number like that definitely signals some serious headwinds, but the real story here is where that pressure is coming from. And you can see that pressure hit the bottom line even harder. Diluted earnings per share took a 53% dive. I mean, a drop of that size really makes you ask, okay, what is going on under the hood? This table lays it all out for us. You can see the revenue falling from about $187 million down to $158 million. But look closer at the operating income. It fell by a whopping 59%. That's a much steeper drop, which tells me margin pressure was a huge factor this quarter. And this chart right here, this is the core story of the quarter in one visual. The irrigation segment, which is their biggest business by far, saw a pretty manageable 5% dip. But meanwhile, infrastructure just plummeted by 58%. This massive difference is the absolute key to understanding this quarter's results. So let's start with irrigation. So moving on to irrigation, this segment was definitely up against some pretty tough market headwinds, especially when you look at commodity prices and farmer sentiment. Those two things directly impact demand for new equipment. And if you break it down by geography, you can see the weakness was really concentrated in North America, with that 8% decline. The international business, on the other hand, held up way better, down just 1%. So clearly, these pressures aren't the same everywhere around the globe. And you don't just have to take my word for it. The CEO, Randy Wood, addressed this head-on. He points right to the weak U.S. market conditions and that pressure from commodity prices as the main thing holding back demand. But he also points out a major international project that's helping to cushion that blow from the domestic side. So to put it all together, North America is struggling with low commodity prices. Brazil is dealing with a credit crunch. But the big silver lining here is this $80 million project in the Middle East and North Africa region. Deliveries for that have started, and it's providing a really crucial stream of revenue from overseas. All right, now for this segment with that, jaw-dropping number, infrastructure. This is where we really need to look past that headline figure to see what's actually going on with the underlying business.
Yeah, a 58% drop. I mean, if you see a number like that in a vacuum, it's pretty alarming, right? It could suggest the business is collapsing. But as we all know, in finance, context is everything.
And here is that critical context. The total revenue drop was about $22 million. But look at the right. The same quarter last year had a massive $20 million one-time project for a road zipper system. That was a huge deal that was never expected to repeat this year. So when you pull that one-off project out of the equation, the entire narrative just flips on its head. The core road safety business, it actually grew by 6%. And this is probably the most important insight of the entire quarter. Beneath that scary headline number, the underlying infrastructure business is actually healthy and growing. Okay, so let's shift gears and turn to the company's financial foundation. For any investor, understanding the balance sheet's strength and how management is using its capital is every bit as important as the quarterly P&L. First off, the company is sitting on a very strong liquidity position with $236 million available. That gives them a ton of flexibility to get through any market downturns and to execute on their strategy. And their leverage is also incredibly low, at just over 1x debt to EBITDA. That signals a really conservative and healthy balance sheet. It means they have plenty of room to take on debt for strategic moves down the road if they need to.
And Lindsay is actively putting its money where its mouth is. They've bought back over $55 million in shares just this fiscal year, with $25 million of that in this quarter alone. This is management signaling to the market that they believe their own stock is a great long-term value.
So management's priorities for their cash are super clear and disciplined. First, support the core businesses. Second, keep an eye out for smart, strategic acquisitions. And third, return capital to shareholders. It's a classic, balanced approach that investors like to see.
All right, finally, let's look at the road ahead. What is management actually expecting for the next few quarters? This gives us a really good sense of how they see these different market trends playing out.
So here's the outlook in a nutshell. For U.S. irrigation, they're expecting things to stay soft for a while. But in Brazil, they actually see a return to growth, which is a great sign. That huge MENA project will be a major revenue driver. They're expecting to book about $70 million from it this fiscal year. And crucially, they expect that core growth in road safety products to continue. So this all leads us to the central question for anyone watching this company. You've got a cyclical downturn in their main irrigation business, but you have this underlying strength in infrastructure, plus a huge international project acting as a buffer. The key question is, can these bright spots bridge the company through the current market softness and set it up for the next wave of growth? And that wraps up our briefing. If you found this analysis helpful, do us a favor and hit that like button and subscribe for more deep dives into company earnings and key market trends. Thanks for watching.